DeepSeek's coming in and changing the AI game. Tariffs are here, and then they're not. The US dollar has strengthened 8% in the past 4 months.
The strength in the US dollar is almost completely explained by stronger economic growth expectations in the US versus overseas, not necessarily tariff threats. Hard to believe, but it looks like equity investors are sort of calling President Trump's bluff.
Foreign stocks look historically cheap in our investment framework. Is now the time to buy?
We don't think so yet. The macroeconomic outlook overseas still is not that great, and there's still tariff threats looming.
But let's cut through the noise, get to the news, talk about what actually impacts our market outlook. If we think about our 4 factors, right? Economic growth, solid in Q4, appears to be accelerating here in Q1 of 2025. Inflation, the threatened tariffs that lasted for about 48 hours, those were in line with our worst case scenario on the inflation front, approaching 3% for PCE for 2025. What's actually been implemented, more in line with our best case scenario, PCE below 2.5%, so that's relatively positive. On the liquidity side, our base case remains 2 cuts for 2025, but as we've talked about a number of times, could see getting to 3 or 4 cuts pretty easily. All 4 underlying signals in our recession model inactive for the first time since 2022. That's right. So Mike, with all of that in mind, what does that mean for markets?
And we're going to start with what it means for earnings, because stock prices follow earnings, right? And what we're looking at, consensus expectations for earnings of the Magnificent Seven. We have 2023, that's obviously in the past, 2024, which is wrapping up right now, and then out into the future, versus other areas of the market, the other 493 stocks, and then value stocks. And on the margin, what we think this improving macroeconomic environment is going to do is it's going to support the other 493 companies, value companies, anything outside of the Magnificent Seven. It's going to support their earnings growth accelerating, hopefully to something in the high single-digit range here in 2025. At the same time, if for no other reason than just the law of large numbers, Magnificent Seven earnings look like they're ready to slow, still at impressive levels. We're talking about 10 to 20%. Right. But I wouldn't call them magnificent. And this environment, this earnings convergence that looks like the base case now, heading out into 2025 and beyond, that's supported by this macro environment, it just creates another incentive for equity investors to diversify out of what had been the only game in town, right? The Magnificent Seven mega cap growth stocks into other areas of the market that have been unloved. I mean, if you go back to 2023, when the Magnificent Seven became magnificent, they grew earnings at 57%. The rest of the market, the other 493 stocks, 0.
Yeah.
No earnings growth whatsoever. There was one game in town. Now it looks like something quite different. And on the margin, this data here year to date, supportive of that earnings convergence.
Yeah. And obviously a good portion of the Magnificent Seven being heavily influenced by AI, expectations around artificial intelligence and how that could lead to further increasing profit margins and results. That's been another one of those narratives in 2025 with the DeepSeek revelation, right? So that's another aspect of this rotation here, right?
Mm-hmm. Yeah, I mean, the AI boom, the AI hype cycle, there were significant barriers to entry. And unless you had multi-billion-dollar CapEx plans, companies really had no way to capitalize on this. So it was isolated to stocks in the Magnificent Seven, like Microsoft, NVIDIA, Meta, et cetera. And because they were the only game in town, they were the only ones that could capitalize on AI. They dominate. They just dominate the index. I mean, if you look at the top 10 holdings, Magnificent Seven are all in there, as a percent of total U.S. equity market cap, we're bumping up against the highest concentration in history. If you think about this differently, we change it from the whole U.S. equity market to the S&P 500. The 10 largest companies in the S&P 500 are 39% of the index. So that's the most top-heavy, most concentrated, or least diversified that index has ever been. And more broadly speaking, if you were to look at a growth index where these companies are so heavily weighted, you're talking about over 50% of a Russell 1000 growth index fund in just 10 holdings. So we know what's happened historically when the market's gotten this top heavy. Investors look for an opportunity to diversify out of the winners, sell high, buy low. And what's happened historically is over the next 3, 5, 10-year time periods, you see smaller cap companies outperforming large cap companies by anywhere from 3.5 to 4.7% annualized. And so, where does DeepSeek come into all of this? If now AI models can be much more efficient, much more cost effective, that idea that you need multi-billion-dollar CapEx plans just to participate in AI, that all comes into question. It resets the entire playing field. Now, in that reset playing field, it's totally possible that these magnificent 7 companies are still going to be winners, but it opens it up to a broader opportunity set of companies that can implement AI effectively to increase margins, design new enterprise solutions, new apps that drive greater adoption, etc. So we think on the margin, that DeepSeek news, it just accelerates AI adoption. And of course, we're hoping it accelerates a rotation into other areas of the market.
Yeah. Yeah. And speaking of broadening and diversifying the opportunity set, let's take it outside of the U.S., looking into foreign equities now. We came into the year rhetorically asking the question of why own anything outside of U.S. stocks, right? Tariffs been a huge area of uncertainty here. They're on again, they're off again. How are we thinking about foreign stocks right now?
Well, just showing where we're at, the starting point is important. Since 2010, you haven't needed to own stocks outside of the U.S. U.S. stocks have dominated the blue shaded area here. You can see that's the outperformance of U.S. versus the rest of the world in terms of equities. And this has happened for so long that it's very easy to forget that these things happen in fits and starts. And they play out over the course of years. And from 2002 to 2007, for example, foreign stocks outperformed U.S. stocks by 10% annualized in every single calendar year, right? So it can change quite quickly. The question, of course, is it going to change right now? Well, our valuations within our investment framework suggest foreign stocks are at the point where they're a bargain, certainly. But when valuations are cheap, there's always a potential for value traps. And unfortunately, they're cheap for a reason. The macroeconomic environment outside of the US is not very supportive of foreign stocks yet. If that macroeconomic environment were to improve, or if the tariff actions fall short of the tariff threats, maybe there's an opportunity there. And if you look at this chart, you see, there would be plenty of room for that opportunity to run foreign stocks and foreign currencies, looking very cheap and unloved for a long time.
Yeah. And to that point of the tariff shocks and the tariff threats, that's been the primary culprit pointed to for differences in performance between foreign and U.S. stocks and difference in those valuations. But based on our research, there could be some other things at play here. Yeah.
Well, we're asking ourselves, you don't need, what would we need in order to get excited about foreign equities? We just said, the macro outlook needs to get better. But 2, if the tariff threats go from underpriced to overblown, that could be an opportunity. So how priced in are these tariff threats into foreign stocks right now, right? The market always thinks ahead of what's going to happen. And in our view, they're not significantly priced. Equity investors globally are, in a way, sort of calling President Trump's bluff, thinking this is just the art of the deal. So if these tariff threats were to actually happen, that could be quite damaging for foreign currencies from here and foreign equities. And so a question is, how do we determine how priced in tariff threats are? Well, you look at the Bloomberg US dollar index. So how has the dollar performed versus other currencies? You see that in green. It's been getting stronger, line go up. That means the dollar's stronger. And the question for us is, well, is it explainable or not? If it's explainable by factors other than tariffs, then the tariffs aren't the reason why the dollar's getting stronger. And this is 100% explainable by interest rate differentials. Since September, 5-year Treasury yields here in the US have risen, and 5-year yields in the rest of the world have fallen because our economic growth, our expectations have been improving. The rest of the world's been getting worse. And so we have higher Treasury yields than the rest of the world. It's justified by our economic fundamentals, not necessarily tariffs. That fully explains the appreciation in the dollar. So investors aren't just flocking to the dollar because they're afraid of tariffs. They're going to the dollar because we have the most attractive interest rates. You get paid to do so.
Yeah.
So that's why we're a bit gun shy, if you will, waiting for a better opportunity on foreign equities. We would need to see the tariff threats really be priced in order to get excited.
Yeah. It is amazing how closely those two lines have moved since last summer.
Right.
Almost in lockstep. So that's the macro picture. On the margins, U.S. macro picture getting better. Closely evaluating the foreign macro picture to see if there might be an opportunity there. Let's tie that with valuations, right? So on the valuation space, you of course still have the mega cap growth stocks, still kind of setting the axis here. Axis here in terms of recent history, but opportunities elsewhere.
Absolutely. If you look at value stocks, they're basically in line with trend. What does that mean? Well, trend for a value index, long-term trend for a value index is something around 9%. So absent any other factors, you would say that's a pretty good estimate of what you should expect in terms of forward-looking returns when you're near trend. And then you go to things like US small caps, which we just talked about, we like in our investment framework. They're below trend.
Yep.
So what does that mean? Well, the long-term trend for a basket of US small caps is closer to 10, 11%, but you have catch-up potential. So they could outperform trend absent other factors. We're talking about, 12, 13, 14% return expectations. Not saying that's going to be the number, but saying there's a margin of safety here. They're not priced for perfection, right?
Right.
If the macroeconomic, even if there are stumbles in the macroeconomic environment, a lot of that's already reflected. The expectations are low. There's a margin of safety. And then foreign equities look screaming cheap, especially in US dollar terms. The cheapest they've looked in our framework for quite some time. But there, once again, we either need to see the macro outlook overseas improve or those tariff threats go from underpriced to overblown before we really view that as an opportunity. Right now, it seems like more of a value trap.
Got it.
Yep.
All right. Well, that will do it for this edition of the Outlook by CAP STRAT. If you have any questions or comments, please feel free to reach out.